Good morning, everyone, and thank you for joining our session today. My name is Jitesh Azad, and I'm Director of Business Development at MBG Corporate Services, holding 14 years of experience in business advice services, and I'm delighted to be your host for today's webinar on Union Budget 2024. In today's session, we will be covering the topics that include policy reforms and initiatives, direct taxes initiatives, and indirect taxes new provisions. Before we dive into the topic, let me introduce our company, MBG Corporate Services. MBG Corporate Services is a premier business solution service provider with a proven track record of helping companies thrive in today's dynamic business environment. Our mission is to empower with the tools, knowledge, and expertise needed to succeed. Established in 2002 and headquartered in Singapore, we are a team of 600 plus professionals operating out of Europe, Middle East, and Asia, with a network of 16 global offices across 8 countries. Over the past 2 decades, we have served more than 5,000 plus clients globally, including 100 of the Fortune 500 companies in the regions which include Middle East, Europe, Japan, China, Singapore, and India. With an innovative approach to every project and unwavering commitment to quality and consistency, we have played an instrumental role in transforming businesses worldwide. MBG Corporate Services operates with specialized international enterprise teams dedicated to assisting clients in various geographic regions across the globe. These teams focus on providing tailored services and support to clients based in specific regions, including India, Japan, Middle East, China, and Europe. By establishing dedicated teams for these geographic regions, MBG Corporate Services demonstrate a strategic approach to understanding and meeting the distinct need of clients in different parts of the world. This enables us to provide more effective and targeted services, fostering stronger client relationships and successful outcomes in each region. MBG Corporate Services offers comprehensive business growth solutions for corporations, guiding them through every stage of from inception to maturity. Our commitment involves delivering personalized, tailor-made solutions that addresses the unique needs of each organization. We are dedicated to supporting businesses throughout their entire life cycle, ensuring a strategic and customized approach to their growth and development. Our services include risk advisory, transaction advisory, market entry, financial reporting, and assurance services. Let's delve a bit deeper into each vertical service offering by MBG. Risk advisory. So basically, like we conduct comprehensive risk assessments and developing risk management strategies tailored to specific industry and organizational needs. Transaction advisory, conducting thorough due diligence, assistance for mergers, acquisition, and other transactions to evaluate financial, legal, and operational aspects. Market entry services, conducting in-depth market research and analysis to identify opportunities, market trends, and potential challenges for successful market entry. For financial reporting and assurance services, conducting audits to ensure the accuracy and completeness of financial statements, providing assurance to stakeholders. Legal advisory, covering contract management, regulatory compliance, and legal structuring. Taxation services, developing tax efficient strategies to minimize tax liabilities and optimize financial resources. Tax compliance and filing, assistance in tax compliance, filing tax returns, and liaising with tax authorities on behalf of clients. Human consulting, including people development, HR, payroll management, compensation benchmarking, structuring. Each of these service verticals demonstrate MBG Corporate Services commitment to offering specialized experience and expertise and comprehensive solutions that cater to the diverse needs of the client across industries. MBG Corporate Services is an industry agnostic firm with expertise in serving clients from various industries. This approach allows us to provide comprehensive and customized solutions that cater to the unique needs and requirements of the clients across different sectors and domains. By serving clients across these diverse industries, MBG Corporate Services demonstrate its versatility and ability to adapt to the distinct requirements and regulations of each sector. I would personally like to thank you all for our clients believing in us. Thank you for joining today's session. Now allow me to introduce our esteemed speaker and our Deputy CEO, Mr. Love Malhotra. Love is a qualified company secretary and a law graduate with more than 15 years of post-qualification experience in advising various domestic and international clients in the field of general corporate advisory, including foreign exchange laws, foreign trade laws, company law, and insolvency and bankruptcy related laws, compliance management, and regulatory services. Thank you, Love, and over to you.
Thank you, Jitesh, for introducing me. Good morning, everyone. I'll start my today's session with Macroeconomy. As per the economic survey, the Indian economy is on a strong wicket and stable footing, demonstrating resilience in the face of geopolitical challenges, ensuring economic and financial stability. The survey emphasized that it is imperative to continue focusing on aspects which were discussed in the interim economic review carried out in January this year. That is to focus on below four aspects: global factors, introduction of artificial intelligence, need to balance energy security and energy transition, and imperatives for employment and skilling. The survey says that it is important to talk about these challenges and how these challenges can be addressed at the very best. It further stated that it is clear that now we need agriculture, we need services, we need private and public sector, we also need the state governments and union government to act together, because the way the global conditions are evolving, we don't seem to have the luxury to choose specific approaches in our path towards developed India. The survey further stated that post-COVID, investment has emerged as a growth driver, which has been driven by not only capex done by center and states, but also by private corporate capex and household savings, which is evident by the fact that private corporate capex grew by 19.8% in FY24 and household savings grew from 10.8% in FY21 to 12.9% in FY23. The survey also recognized that though India is the top remittance recipient country globally, with remittances reaching a milestone of USD 120 billion in 23, net FDI inflows to India declined from USD 42 billion during FY23 to USD 26.5 billion in FY24 as an impact of decline in global FDI flows. And thus, it is imperative that focus must remain on improving the ease of doing business across all sectors of government, be it national, state, local, and across all regulators, in order to attract more and more FDI. The survey seems to be also focusing on having a tripartite compact between government, private sector, and academia as an important step to tackle inequality, improve the young population's health in the short to medium term, and bridging the education employment gap over time in order to sustain the growth momentum in the country. Well, like every economy, Indian economy also revolves around GDP, fiscal deficit, inflation, forex reserves, and receipts and expenditure. Let me quickly take you through them one by one. Starting with GDP growth. As per the survey, the Indian economy seems to be in a decent position, as the GDP growth remains steady in FY24. As you can see on the slide over here, despite a gamut of global and external challenges, India's real GDP grew by 8.2% in FY24, which was last year projected to be in the range of 6 to 6.8%. Next important parameter is inflation. As appearing on the slide, inflation seems to be under control on account of requisite combined measures taken by government and RBI, such as open market sales, retailing in specified outlets, timely imports, resulted in reduced LPG and fuel prices. So the retail inflation declined from 6.7% in FY23 to 5.4% in FY24. Next parameter, well, it is very important for almost all the nations. As you can see on the slide, the figures depicted in the graph shows the fluctuation in the past years. However, the forex reserve had been increased from FY23 and reached 646.40 billion by the end of FY24 on the account of progressive policy reforms, economic stability, fiscal prudence, and attractive investment avenues. Next parameter is fiscal deficit. Well, against the global trend of widening fiscal deficit and increasing debt burden, India has always remained on the course of fiscal consolidation through efficient and prudent fiscal management. Further, the government attempts to finance the fiscal deficit through various sources, such as debt receipts, market borrowings, state provident funds, external debt, etc. As appearing on the slide, the fiscal deficit has been brought down from 6.4% of GDP in FY23 to 5.6% of GDP in FY24, which the government is expecting to further drop to 4.5% of GDP or lower by FY26. Next one is receipts and expenditure. Well, the finance minister has placed the revised estimates for FY23-24 and budget estimate for FY24-25 in the economic survey. As you can see on the screen, revised estimates of total revenue receipts for FY24 is INR 27,000 billion, which is less than the revised estimates of revenue expenditure. Similarly, revised estimates of total capital receipts for FY24 is INR 17,900 billion, which is more than total capital expenditure. Let me now walk you through the sectors which have contributed to growth and development of Indian economy in FY 23-24. Starting with the agriculture, the performance of the agriculture sector remains critical for the economy's growth. Overall, the sector has been growing at an average growth rate of 4.18% over the last 5 years. As many as 8195 FPOs have registered under the new Farmer Producer Organization scheme as of February 24. Further, the livestock sector grew at compound annual growth rate of 7.38% at constant prices during the period from 2014-15 to 2022-23. Next important sector is industry. As you can see on your slide, in FY24, the industrial sector made up about 28% of India's economy. Manufacturing and construction saw nearly double-digit growth, while mining, quarrying, and utilities also performed well. India's overall industrial growth was driven primarily by manufacturing and construction. Since 2014, the electronic manufacturing sector also has expanded significantly, contributing close to 4% of GDP in FY22 and attracting substantial investment and manufacturing capacity. Next sector is services sector. In FY24, the services sector rebounded significantly, contributing around 55% to India's economy, up from a major drop in FY21 on account of pandemic. Additionally, service exports made up 44% of India's total exports. This growth is attributed to a surge in tech startups, which increased from 2,000 in FY14 to whopping 31,000 in FY23, and an improvement in the services purchasing managers index, which reached 61.2 in March 24. Now let's find out what's in store for all of us in the union budget presented last week. Well, this year's budget provides a blueprint for India's future, reflecting a strategic vision aimed at fostering robust economic growth and social equity. As you can see on the slide, the budget focuses on empowerment and well-being of four major castes, just like interim budget: poor, youth, women, and farmer. This year's budget theme was more inclined towards employment, skills, MSMEs, and middle class. Accordingly, this year's budget revolves around 9 priorities: productivity and resilience in agriculture, employment and skilling, inclusive human resource development and social justice, manufacturing and services, urban development, energy security, infrastructure, innovation, research and development, and next generation reforms. We have accordingly categorized the policy reforms proposed as part of above 9 priorities in the budget into major sectors such as agriculture, physical infrastructure, digital infrastructure, tourism, urban development, social energy, healthcare, based on their contribution to economic growth of the nation. Let us have a look at them one by one. Starting with the agriculture sector, as discussed in the above slides of macroeconomic section, agriculture continues to be the biggest contributors to India's GDP. Accordingly, in this budget, the government has allocated INR 1520 billion for its growth. In this budget, the FM announced a bunch of new initiatives like introduction of new 109 high-yielding and climate-resilient varieties of crops and natural farming, which would certainly give protection to the farmers and boosting the agriculture sector. Further, announcement to finance processing and export of shrimp farming through NABARD is expected to give robust growth to Indian agriculture sector by expanding shrimp farming and its exports. Well, in this budget, government has talked about both physical and digital infrastructure. Let me start with physical infrastructure. Well, by virtue of this budget, the government have allocated outlays towards various areas as a part of physical infrastructure. Financial investment in various corridors, namely Patna-Pune Expressway, Buxar-Bhagarpur Expressway, and others, are some of the key investments of the government, which would definitely going to uprise physical connectivity and reduce congestions in the country. Additionally, setting up of power projects with 2,400 megawatt capacity, new airports, medical colleges, and sports infrastructure is expected to boost nation's infrastructure. Next is digital infrastructure. Well, we all are quite aware that our digital infrastructure helped us a great deal in managing the biggest crisis of the era, that was pandemic. It was therefore imperative that just like past years, a proposal for spending is made toward digitization as well. In this year's budget, the initiative of digital public infrastructure, starting with a digital crop survey for Kharif in 400 districts and ensuring 60 million farmers and their lands to be registered will not only stabilize rural economies but also attain rural development and self-sufficiency. Next important sector is tourism. Tourism for any nation is of utmost importance, not only for its economic growth, culture preservation, but also for boosting its forex reserves. In this budget, the announcement of development of Nalanda as tourist center, revival of Nalanda's university, including development initiative for Rajgir, holding religious significance amongst India's diverse population, is considered to be a commendable move by the government to boost tourism in India. Next important sector is urban development. The shift of ruralization to urbanization showcases a holistic approach of the government of India by improving infrastructure through orderly development of peri-urban areas and brownfield redevelopment of existing cities and transit-oriented development plans for 14 large cities which aims at creating more livable and sustainable urban environments. Next one is of utmost importance to everyone, energy sector. Climate action and sustainability have been a key topic of discussion as well as implementation, especially in the past years, not just in the country, but globally. Accordingly, the investment in energy sector is the need of the hour to curb the pollution levels by reaching net zero carbon levels and thereby improving the overall health of the citizens of the nation. In this regard, government has taken a lot of effective measures under energy sector in this budget. Announcement of solar scheme giving free electricity up to 300 units for the residential use. Announcement of pumped storage policy for facilitating electricity storage and growth of renewable energy. Announcement of financial support to MSMEs in a drive to adopt cleaner forms of energy are some of the examples. Next sector is healthcare. The announcements made by government in this year's budget is a welcome step to address the long-standing gaps in the India's healthcare ecosystem and to address emerging health threats and achieving universal health coverage. In light of this, government had made significant outlays in National Health Mission, Indian Council for Medical Research, and in its Ayushman scheme in order to make a comprehensive approach towards building a healthy India. Next one is important for all the MSME sector. Well, as expected, the intention of the government has always been to significantly boost MSMEs. In this budget also, accordingly, government has taken varied measures for MSME. Revamping of credit guarantee scheme for machinery and equipment without additional collateral and third-party guarantee. Enhancement of Mudra loans threshold, etc. are some of the key measures taken by the government in this budget. Next one is ease of doing business initiatives. It is of utmost importance for everyone in this present scenario. Government has been taking consistent measures time and again to boost its initiatives of ease of doing business in India. Let us have a look at those measures. As you can see on the screen over here, to expedite resolution process under IBC, additional tribunals are expected to be set up, out of which some would be dedicatedly focusing on Companies Act only. To speed up recovery, additional debt recovery tribunals to be set up, introduction of Jan Vishwas Bill 2.0 to achieve digitization and business reforms, and streamlining process for closure of LLPs are some of the key initiatives taken as a part of ease of doing business initiative by the government. Well, to sum up, I would like to state that the proposed policy measures announced in this budget showcases that India is embarking on a transformative journey characterized by an innovative approach to economic development, illustrating a commitment to strategically underscoring India's ambition to position itself as a global leader in the evolving economic landscape. That's it for my side in this session. Thank you so much for your patient listening. Over to you, Jitesh.
Thank you, Love, for giving us insights into the overall macro picture, key GDP numbers, and financial projections, including sectoral analysis, including in the Union Budget 2024 and Economic Survey. Now, let me introduce our next speaker, Mr. Janardhan Singh. Mr. Janardhan Singh is CEO at MBG Corporate Services and has a 17 years of post-qualification experience in consulting, dealing with matters pertaining to corporate tax, international tax, transfer pricing, expatriate tax, and due diligence. Mr. Janardhan has focused on international tax and corporate tax issues related to EPC, contracts, project office operations as his area of specialization. Over to you, Mr. Janardhan.
Good morning, everyone. Thank you, Jitesh, for the introduction, and thank you, Love, for an insightful session on macroeconomic overview and key policy initiatives. In this session, we are going to cover the key direct tax amendments proposed Wide Finance Bill number 2, 2024. Holmes Jr. mentioned that taxes are the price we pay for a civilized society. In this budget, the focus was mainly on simplification, rationalization, and proper administration of tax laws. We can start with amendments proposed in the tax rates. For individuals, there is no change in old tax regime. However, few changes have been proposed under new tax regime. As per the new slab, income from 0 to zero point 0.3 million shall be taxed at nil. Zero point 0.3 to 0.7 million shall be taxed at 5%. Zero point 0.7 to 1 million shall be taxed at 10%. And there is no change in other slab rates. Further, no changes in the tax rates have been proposed for cooperative societies, firms, local authorities, and domestic companies. However, in case of foreign companies, the income tax rates has been proposed to reduce to 35% from 40%. And there is no change in surcharge and cess. Few other changes have been proposed to make new tax regime more attractive, such as increase in standard deduction from 50,000 to 75,000 for the salary income, increase in family pension deduction from 15,000 to 25,000 for the family pension income, and increase the limit for deduction for employees pension scheme to 14% of the employee's salary in case of non-government employer. It is proposed to increase the deductible amount of employer contribution towards pension scheme from 10% to 14% of the employee's salary. As per section 47, transfer of a capital asset under a gift or a will or an irrevocable trust is not considered as transfer. Since gift is given out of natural love and affection, it is proposed to restrict this provision to apply in case of individuals or HUF only. As per section 50, capital AA, capital gain on transfer of units of specified mutual fund or a market linked debenture shall always be deemed to be short term capital asset irrespective of holding period. It is proposed to include unlisted debentures and unlisted bonds transferred, matured, or redeemed on or after 23rd of July 2024. Presently, specified mutual fund means a mutual fund where not more than 35% of its total proceeds are invested in equity shares of domestic companies. It is also proposed to amend specified mutual fund as a mutual fund where more than 65% of its products or proceeds are invested in debt, money market instruments, and funds that invest 65% or more of their total proceeds in units of such mutual fund with effect from 2026-27. To simplify the provisions of capital gain, it is proposed that there will be only two holding periods, 12 months and 24 months, for determination of short-term capital gains or long-term capital gains respectively. The holding period for all listed securities is proposed to be 12 months, and for any other assets, it is proposed to be 24 months. Tax rate on short-term capital gain on transfer of STT paid equity shares, units of equity-oriented fund, business trust, and transfer of securities by FIIs are proposed to increase from 15% to 20%. Long-term capital gains rate under various sections is proposed to be 12.5% in respect of all categories of assets. This rate earlier was 10% for STT paid listed equity shares, units of equity oriented fund, and business trust under section 112 capital A. And for other assets, it was 20% with indexation under section 112. However, to rationalize rate of 12.5%, indexation is proposed to be removed for determination of any long-term capital gains. Further, an exemption of long-term capital gain under section 112 capital A and section 115 capital AD has been proposed to increase from 0.1 million to 0.125 million. It is proposed that the payment by a domestic company to shareholders on buyback of shares shall be treated as dividend in the hands of shareholders. Further, no deduction for expenses shall be available against such dividend income. The cost of acquisition of buyback share would generate a capital loss in the hands of shareholders, which can be subsequently set off with capital gain from sale of shares. During the assessment proceedings, TPO can proceed to determine the ALP of the international transactions, even if it is not referred by the AO or not reflecting in the audit report. It is now proposed to apply this in case of specified domestic transactions also. Now it is proposed to empower CIT appeals to set off or set aside the cases where AO has passed the best judgment order and remand back the cases to AO for fresh assessment. These amendments will take effect from 1st October 2024. Section 148A is proposed to be amended to provide that the show cause notice by the AO shall accompany the information which suggests that income has escaped assessment. Further, it is also proposed to revise the timelines for issuing notice under Section 148 from 3 years to 3 years and 3 months under normal cases. However, timeline for revise is from 10 years to 5 years and 3 months under specific cases. This amendment will take effect from 1st September 2024. Presently, there is no time limitation for issuance of so-called notice under Section 148A. Now it is proposed as 3 years in normal case, and in specific case it is 5 years from the end of the relevant assessment year. This amendment will take effect from 1st September 2024. In case of search and seizure, it is proposed to move to earlier regime of having separate chapter for conducting search and seizure proceedings under Section 153 BC and Section 153 BD. Now, block periods shall consist of financial years relevant to 6 assessment years preceding the financial year in which the search was conducted. Consolidated assessment order shall be passed for the block period with tax at 60% on the undisclosed income. There will be no interest under Section 234A, 234B, or 234C, and there will be no penalty under Section 270 capital A in respect of undisclosed income. The penalty shall be levied at 50% of the tax payable on undisclosed income. However, no penalty shall be levied if the undisclosed income shall be offered in the return furnished in pursuance of such, and taxes shall be paid along with the return. There are provisions which provides for prosecution in case of failure to pay TDS. It is proposed to provide exemption from prosecution if the payment of TDS in respect of a quarter has been deposited at any time on or before the time limit prescribed for filing the TDS return of such quarter. This amendment will take effect from 1st October 2024. It is proposed to provide that no order shall be made deeming any person to be assessee in default for failure to deduct TDS from any person at any time after the expiry of 6 years instead of 7 years from the end of the financial year in which payment is made or credit is given, or 2 years from the end of the financial year in which revised TDS return is delivered, whichever is later. It is proposed to provide that no order shall be made deeming any person to be assessee in default for failure to collect TCS from any person at any time after the expiry of 6 years from the end of the financial year in which the tax was collectible, or 2 years from the end of the financial year in which the revised TCS return is delivered, whichever is later. These amendments will take effect from 1st April 2020. Now we can discuss Vivad Se Vishwas Scheme 2024. So now it has been introduced as a direct tax Vivad Se Vishwas Scheme 2024, and it enables settlement of disputes and appeals pending as on 22nd of July 2024. The amount to be paid by taxpayer opting to settle their disputes under this scheme in case of disputed tax, interest and penalty thereon, if appeal is filed after 31st January 2020, but on or before 22nd July 2024, 100% if deposited by 31st of December 2024, and 110% if deposited thereafter. However, if appeal is pending at same forum on or before 31st of January 2020, 110% if deposited by 31st of December 2024 and 120% if deposited thereafter. Further, in case of disputed interest, penalty and fee, if the appeal is filed after 31st January 2020 but on or before 22nd July 2024, 25% if deposited by 31st of December 2024 and 30% if deposited thereafter. However, if appeal is pending at same forum on or before 31st of January 2020 but 30% if deposited by 31st of December 2024 and 35% if deposited thereafter, the amount payable would be reduced to 50% in the cases where the taxpayers has favorable decisions on related issues from ITAT or high courts or supreme courts, and where appeal has been filed by tax authorities. If the tax payable under this scheme is less than the amount already paid under litigation, the excess will be refunded without any interest. In a case where the dispute in relation to an assessment year relates to reduction of MAT or AMT credit or any loss or depreciation computed thereunder, the appellant shall have an option either to include the amount of tax related to such tax credit or loss or depreciation in the amount of disputed tax, or to carry forward the reduced tax credit or loss or depreciation in a prescribed manner. This scheme will not apply for search, seizure, prosecution, undisclosed income, asset located overseas, and proceedings under other specified laws being instituted. Presently, assessing officer has authority to adjust the refund against any outstanding tax demand of the taxpayer, and it can also be withheld till the date on which such assessment or reassessment is made. It is now proposed to increase the period of withholding of refund from the existing period of up to the date of assessment to 60 days from the date such assessment is made. These amendments will take effect from 1st October 2024. Presently, the time limits for passing penalty order under section 275 is determined based on the receipt of relevant assessment order in office of principal commissioner or chief commissioner of income tax. It is proposed to remove the references made to date of receipt of order by principal commissioner, chief commissioner of income tax from section 275. This amendment will take effect from 1st October 2024. It is proposed to amend the time limit for filing of appeal before ITAT to 2 months from the end of the month in which order is sought to be appealed against is communicated to the SSC or the principal commissioner or commissioner instead of 60 days on which the order sought to be appealed against is communicated to the principal commissioner or commissioner. These amendments will take effect from 1st October 2024. Presently, there is no provision to consider TCS collected while making the deduction under section 192. It is now proposed to amend section 192 to expand the scope to include any TCS collected to be considered for the purposes of making the deduction under section 192. These amendments will take effect from 1st October 2024. Remuneration paid to a working partner can be claimed as deduction while computing the taxable income of a partnership firm as per the limit prescribed under section 40B. Presently, on the first 3 lakh of the book profit or in case of loss, 1,50,000 or 90% of the book profit, whichever is higher, is allowed as deduction in the hands of the firm. On the balance book profit, 60% of the book profit is allowed as deduction in the hands of the firm. It is proposed to amend the limit on the first 6 lakh of the book profit or in case of loss, 3 lakh or 90% of the book profit, whichever is higher, shall be allowed as deduction in the hands of the firm. On the balance book profit, 60% of the book profit shall be allowed as deduction in the hands of the firm. This amendment will take effect from 1st April 2025. A new section 194T is proposed to be inserted to provide for deduction of TDS at the rate of 10% on payments being made to the partners of the firm in respect of salary, remuneration, commission, bonus, and interest to any account, including capital account. TDS shall be deducted at the time of credit or payment, whichever is early. Threshold limit for TDS to be deducted shall be the sum or aggregate of sum credited or paid to the partner exceeding 20,000 during the financial year. These amendments will take effect from 1st April 2025. To allow the claiming of TCS credit in the hands of person other than collectee, it is proposed to introduce a provision in section 206C in this regard, and this proposal will cover cases under the LRS of RBI where remittance may have been remitted in the name of minor and tax would have been collected under section 206C 1G, where the income of the minor is being clubbed with the parent. In that case, only the credit of the TCS of the minor shall be allowed to parent. These amendments will take effect with effect from 1st January 2025. To provide an option to seek a lower deduction or collection certificate, it is proposed to amend section 197 and section 206C to bring it in its ambit section 194Q related to TDS by buyer and section 206C 1H related to TCS by seller, respectively, to seek a lower deduction or collection certificate in such cases. These amendments will take effect from 1st October 2024. Proviso to section 200 provides that a person may deliver correction statements, or you can say revised return, in respect of the statement detailing the tax deducted under section 200 subsection 3, and section 206C subsection 3B provides that a person collecting tax may deliver a revised return in respect of the statement detailing the tax collected furnished under such section. Presently, there is no time limit for furnishing the revised TDS and TCS. Hence, it is proposed to provide that revised TDS and TCS returns shall be delivered within 6 years from the end of the financial year in which such returns were delivered. These amendments will take effect from 1st April 2025. Presently, no penalty shall be levied if the person proves that after paying TDS, TCS along with fee and interest, the person has filed the TDS and TCS return before the expiry of period of 1 year from the time prescribed for furnishing such return. It is now proposed to reduce the timeline to before the expiry of period of 1 month from the time prescribed for furnishing such return. These amendments will take effect from 1st April 2025. It is proposed to amend section 37 to clarify that any expenditure incurred by an assessee to settle proceedings initiated in relation to a contravention under any law would be deemed to have been incurred for an expense which is an offense or is prohibited by law. Hence, it would not be allowed as deduction while computing the taxable income. It is proposed to reduce the TDS under section 194D, that is the payment of insurance commission in case of person other than company, from 5% to 2% with effect from 1st April 2025. It is proposed to reduce TDS under section 194DA, 194G, 194H, 194IB, 194M from 5% to 2% with effect from 1st October 2024. Further, it is also proposed to reduce the TDS under section 194O from 1% to 0.1% with effect from 1st October 2024 and to omit section 194F with effect from 1st October 2024. Amendment is proposed in section 206C subsection 7 to specify that interest for non-payment of TCS shall attract simple interest at the rate of 1.5% instead of 1% for every month or part thereof from the date on which such tax was collected to the date on which such tax is actually paid. This amendment will take effect from 1st April 2025. Presently, section 206 C1F mandates seller to collect TCS on sale of motor vehicles of the value exceeding INR 1 million. It is proposed to amend this section to also levy TCS on any other luxury goods of value exceeding 1 million as may be notified by the central government. This amendment will be in effect from 1st January 2025. Section 194 IA provides for a deduction of TDS at 1% on the consideration paid or stamp duty value of the immovable property, whichever is higher, where either of the consideration paid or stamp duty value is 5 million or more. It is now proposed to clarify that where there is more than one transferor or transferee in respect of an immovable property, such consideration shall be the aggregate of the amounts paid by all the transferee to the transferor or all the transferors for transfer of such immovable property if such consideration is 5 million or more. This amendment will be effective from 1st October 2024. Section 194C deals with TDS on payments to contractors and Section 194J deals with TDS on fee for professional and or technical services. It is proposed to amend definition of work for the purpose of Section 194C to state that any sum referred to in Section 194J does not constitute work for the purposes of TDS under Section 194C. So this amendment will take effect from 1st October 2024. Presently, as per Section 56, subsection 2, Roman 7b, where a private company receives in any previous year from any resident person any consideration for issue of shares that exceeds the face value of such shares, the aggregate consideration received for such shares as exceeds the fair market value of the share shall be chargeable to income tax under the head income from other sources. It is now proposed to amend section so as to provide that the provisions of this section shall not apply from assessment year 2025-26. Presently, section 44B provides presumptive taxation for shipping business of non-residents. It is proposed to amend section 44B to provide that provisions of this section shall not apply to cruise ship business from assessment year 2025-26. It is also proposed to insert new section 44 capital BBC, that is a presumptive taxation regime whereby 20% of the aggregate amount received by or paid to non-resident cruise ship operators shall be deemed to be an income from the business. It is also proposed to insert section 1015 capital B, which exempts the lease rentals paid by the non-resident cruise ship operators opting for presumptive taxation under section 44 capital BBC in the hands of recipient foreign company, provided both companies are the subsidiary of the same holding company. Presently, any amount of distributed income by the company on the buyback of shares from a shareholder shall be charged to tax at the rate of 20% on the distributed income in the hands of the company. It is proposed to amend that the payment received by the shareholders towards buyback of shares shall be taxable in the hands of such shareholders as dividend at the applicable income tax rates without deduction of expenses against such dividend income. Further, the cost of acquisition of such shares being bought back by the company would create a capital loss in the hands of shareholders and shall be allowed to be set off against any other capital gain from sale of shares or carry forward to the subsequent year. This amendment will also apply from 1st October 2024. Section 198 provides that all sums deducted in accordance with the foregoing provisions of the chapter shall be deemed to be income received for the purposes of computing the income of an assessee. It is now proposed to amend this section that any sums deducted in accordance with the provision of chapter 17B and any income tax withheld outside India shall be deemed to be income received by the assessee. This amendment will take effect from assessment year 2025-26 and subsequent assessment years. It is proposed that equalization levy at the rate of 2% shall not be applicable to consideration received for e-commerce supply or services on or after 1st of August 2024. Accordingly, exemption available under section 1050 due to levy of equalization levy shall not be applicable with effect from 1st April 2000 or 1st August 2024. As per section 285, a non-resident having a license office in India shall be required to prepare and deliver a statement in respect of its activity during the financial year to the assessing officer within 60 days from the end of such financial year. It is proposed to amend section 285 to provide that the period within which such statement is to be filed be prescribed under the income tax rules. It is proposed to insert section 271 capital GC to provide that failure to furnish statement may attract a penalty of 1,000 per day up to 3 months and 1 lakh in any other case. These amendments will take effect from 1st April 2025. Section 231A provides that no person who is domiciled in India shall leave India unless he obtains a certificate from the income tax authorities stating that he has no liability under Income Tax Act or Wealth Tax Act or Gift Tax Act or Expenditure Tax Act, or he makes satisfactory arrangements for the payment of such taxes which may be payable by that person. Now, such certificate is required to be obtained where circumstances exist which, in the opinion of an income tax authority, render it necessary for such person to obtain the same. It is proposed to amend section this to insert the reference of liabilities under the black money law for the purposes of obtaining a tax clearance certificate under this section. This amendment will take effect from 1st October 2024. Section 132B provides that any existing liability under the Income Tax Act, Wealth Tax Act, Expenditure Tax Act, Gift Tax Act, and Interest Tax Act, and the amount of liability determined on completion of the assessment or reassessment in consequence of search or requisition may be recovered from the taxpayer out of the seized assets. It is therefore proposed to amend section 132 capital B to insert the reference of black money law for the purposes of recovery of liability out of seized asset. This amendment will take effect from 1st October 2024. It is proposed that the penalty shall not be imposed due to non-compliance of section 1 or section 42 and 43 of the black money law in case the aggregate value of assets other than immovable property does not exceed 20 lakhs, or you can say 2 million. This amendment will take effect from 1st October 2024. Presently, there is no time limit for a Binamidar or beneficial owner to file submission to the notice issued. It is proposed to provide the maximum time limit of 3 months from the end of the month in which notice is issued to them. Time limit of 90 days is provided to initiating officer to provisionally attach the property. It is proposed to increase the time limit to 4 months from the end of the month in which notice is issued. Time period of 15 days from the date of attachment order is allowed to the initiating officer to draw up a statement of the case and refer it to the adjudicating authority. It is proposed to increase the time limit to 1 month from the end of the month in which the order has been passed is issued. Thank you for attending the session. My colleague Rashi will take you through the key indirect tax proposals in the next session. I am now handing over to.
Thank you, Mr. Janardhan, for giving us insights in changes in tax structure, new taxes, introduction on financial products, and important new sections which are included and deleted. Now, let me introduce our next speaker, Ms. Rashi. Ms. Rashi Paliwal is Associate Partner in Indirect Tax Practice of MBG Corporate Services. She is having 11 plus years of experience in tax advisory, compliances, and litigation in both industry and consulting firms. Rashi has handled imported tax assignments of varied industries: telecommunications, tour and travel, residential and commercial real estate, SEZs, hospitality services, NBFC, and publishing houses. Over to you, Rashi.
For the introduction. Union Budget 2024. From indirect tax perspective, we will be focusing on the legislative amendments in GST and custom laws. To start with, undenatured extra neutral alcohol or rectified spirit used for manufacture of alcoholic liquor for human consumption is added in the provisions of levy and collections in order to keep it out of the purview of GST laws. A new section 11A is introduced to regularize non-levy or short levy of tax due to general practice prevalent in trade. As per this section, government can direct for non-payment of tax in cases wherein tax is payable as per the provisions of the GST laws. However, as per the general practice, no tax is being levied. The government can also direct for short payment of tax in cases wherein higher rate of tax is applicable as per the GST laws. However, as per general practice, lower rate is being levied. So this is a good initiative to streamline tax positions across sectors in industry to rationalize general trade tax practices. Next amendment in GST laws is in the time of supply provisions. As we all are aware that time of supply provisions for RCM supplies means reverse charge supplies are different from regular supplies. As per the existing provisions, time of supply for supplies attracting tax under reverse charge mechanism shall be earlier of the following dates as appearing on the left side of the screen. It is the date of payment as entered in the books of accounts of the recipient or the date immediately following 60 days from the date of issue of invoice. In this union budget, the government has amended the above clause B and the amended clause now says the date immediately following 60 days from the date of issue of invoice or any other document by whatever name called in lieu thereof by the supplier in case where the invoice is required to be issued by the supplier. So the major amendment is second clause will be applicable in case the invoice is required to be issued by the supplier. That means in cases wherein tax is to be paid under reverse charge mechanism and invoice is to be raised by the supplier, then the existing provisions will prevail. However, in cases wherein invoice is to be generated by the recipient, then in that case, a new clause is added as clause C to the existing provisions, which states that the date of issue of such invoice by recipient will also be one of the dates. That means in cases wherein the recipient is mandatorily required to raise self-invoice, then the time of supply shall either be the date of payment or debit in the bank account of the recipient or the date of issue of invoice by recipient, whichever is earlier. Similar amendment is proposed in the section of tax invoice to provide for enabling provisions for prescribing the time limit of issuance of such self-invoice. The another major amendment proposed in the Union Budget 2024 is the introduction of two new subsections in section 16 to rationalize eligibility of ITC in certain cases. So one insertion is subsection 5, which is to extend the time limit to avail ITC in GSTR 3B for the financial year 2017-18 to financial year 2021 up to the 30th November 2021. And the second one is for ITC with respect to revocation of cancellation of registration. So in this case, registered person is entitled to avail ITC on the invoices pertaining to the period from the date of cancellation of registration to the date of revocation of cancellation of registration in case the relevant 3B return is filed within 30 days of such revocation, provided that the time limit prescribed under section 16(4), which is 30th November of next financial year, is not lapsed at the time of such cancellation. So earlier, registered persons were facing challenges in availing ITC for the period between cancellation of registration and its revocation. Another change which is proposed in the union budget is in section 17(5), which provides for the provisions of blocked or ineligible credit. Earlier, any tax payment, if made under section 74, that is in the cases of fraud or willful misstatement, was not allowed as input tax credit. Now, this section is amended to restrict this ineligibility of ITC up to the financial year 23-24 only. So now we can conclude that ITC of tax paid under section 74 will be allowed from financial year 24-25. Another change is in section 51 of the GST Act, which provides for the provision of deduction of tax at source by government authorities and other specified categories of persons. Such specified deductors are required to file monthly return in Form 7 by 10th of subsequent month. As per the existing provision, this return is required to be filed only for the months of deduction. However, with this new amendment, a proviso is added to this section, as can be seen on the screen, to make the filing of return mandatory for all the months, even if there is no deduction of tax. So that means every deductor has to file monthly return on regular basis. Next amendment is proposed in section 71. While making an insertion of subsection 1A, this section 71 itself provides power to proper officer to summon any person for inquiry proceedings, and these proceedings are deemed as judicial proceedings. By inserting this new section 1A, which is appearing on the right hand side of the screen in bold, the government has made it mandatory for the summoned person to either appear in person or through authorized representative, which was not the case earlier. As we all know that section 73 provides for determination of tax for non-fraud cases, whereas 74 of the GST Act is applicable for fraud cases. The major change introduced in this year's budget in GST laws is restriction of applicability of section 73 and 74 to financial year 23-24 only. And now the question arises as to how the tax will be determined post financial year 23-24. For this, Union Budget has introduced a new section 74A to the GST Act. We may say that this section is introduced as a merger of provisions of section 73 and 74. This new section applies to both fraud and non-fraud cases. The major provisions of this proposed section are: 1. Show cause notices for discrepancy, errors or omissions shall be issued within 42 months from the due date of furnishing of annual return. Similar to existing provisions, penalty for any reason other than the reason of fraud to evade the tax shall be equivalent to 10% of tax or INR 10,000, whichever is higher. And penalty for the reason of fraud to evade the tax shall be equivalent to tax due. In this new proposed section, the final order shall be issued within 12 months from the date of issuance of show cause notice, which means practically it should be issued within 54 months, or we may say within 4.5 years from the due date of filing of annual return. If we analyze the penal provisions in detail for section 74A, it appears that there are three scenarios majorly covered by it. One is payment of tax before issuance of show cause notice. In such case, if the notice is issued for non-fraud cases or to be issued for non-fraud cases, then if the taxpayer pays the tax along with interest voluntarily and inform the proper officer in writing, then no show cause notice will be issued under this section. Further, no penalty shall also be imposed. However, in fraud cases, if the taxpayer pays the tax along with applicable interest and penalty equivalent to 15% of tax and inform the proper officer in writing, then only no notice shall be issued under this section. Second scenario is if payment is made after issuance of show cause notice. In non-fraud cases, if taxpayers decides for payment of tax along with the applicable interest within 60 days of issuance of show cause notice, then all the proceedings shall be deemed to be concluded and no penalty shall also be imposed. However, in cases of fraud or willful misstatement, if the taxpayer pays the tax along with applicable interest and the penalty equivalent to 25% of the tax within 60 days of issuance of show cause notice, then only proceedings shall be deemed to be concluded. There is one more scenario which is only applicable in fraud cases. If the taxpayer pays the tax along with applicable interest and the penalty equivalent to 50% of tax within 60 days of communication of order, then also all the proceedings shall be deemed to be concluded. Next amendment is with respect to the amount of pre-deposits. So the maximum amount of pre-deposit for the appeal to first appellate authority has been reduced to INR 20 crores from existing 25 crores. On similar lines, the maximum pre-deposit amount for the appeal to appellate tribunal has been reduced to 20 crores from INR 50 crores. Also, the percentage of pre-deposit has been reduced to 10% from 20% at appellate level. Another change proposed in the provision of appeal to appellate tribunal is in the prescribed time limit for filing such appeal. As per the proposed provision, an appeal to appellate tribunal can be filed within a period of 3 months or the date as may be notified by the government on the recommendation of the council, whichever is later. The government has inserted section 128A to provide waiver of interest and penalty for the financial year 2017-18 to financial year 19-20 if due tax liability has been deposited by the registered person against ongoing demand notices or litigations. Please note that this waiver of interest and penalty is only applicable for the cases of other than fraud or willful misstatement, that is, the notices issued under Section 73 of the GST Act. This waiver is proposed by the government while keeping in mind the target of reduction in number of litigations. However, it is pertinent to note here that demand of erroneous refund for non-fraud cases is not covered in the proposed waiver of interest and penalties. Certain additions are also proposed in Schedule 3 of the CGST Act. Schedule 3 provides for the list of goods or services which are considered as neither supply of goods or services for taxability under the GST Act. To give you all a brief background for the amendment proposed for insurance sector, please note the DGGI had issued demand notices worth INR 20,000 crores approximately to insurance companies for payment of GST on reinsurance premium and co-insurance agreements. In this matter, industry was of the view that since the GST on the entire value of insurance premium is already paid by the lead insurer or co-insurer, including on the share of premium belonging to the co-insurers, hence depositing GST again will lead to double taxation. In order to avoid such double taxation, government has accordingly proposed to insert entry number 9 and 10 in Schedule 3 of the CGST Act, which states that co-insurance premium apportioned by lead insurer to the co-insurer for supply of insurance services provided jointly by lead insurer and co-insurer to the insured in co-insurance agreements is proposed to be declared as no supply under Schedule 3 of the CGST Act, since the lead insurer has already deposited the tax liability on the entire amount of premium paid by the insured. Further, it is also proposed that the services by the insurer to the reinsurer in reinsurance agreements for which the ceding commission or the reinsurance commission is deducted from the reinsurance premium paid by the insurer to the reinsurer shall also be treated as neither supply of goods nor supply of services. However, the tax liability on the gross reinsurance premium, inclusive of reinsurance commission or the ceding commission, is paid by the reinsurer. This insertion in Schedule 3 provides a big relief to the ongoing litigations in the insurance sector for these co-insurer and reinsurance agreements. Now, we can move forward to the major changes proposed in the Customs Act 1962. So, as per Section 28DA of the Custom Act, importer is required to declare and submit certificate of origin issued by the relevant authority of exporting country to prove that goods have been originating in that country as per the existing provisions. Under various newly signed trade agreements, preferential rate of duty can be claimed based on self-declaration. Therefore, in order to align the custom provisions with new trade agreements, aforesaid section 28DA is amended to add that proof of origin can be a certificate or a declaration issued in accordance with the trade agreement, certifying or declaring that the goods fulfill the country of origin criteria and other requirements specified would be accepted. Change is also proposed in section 143AA of the Customs Act 1962, which empowers the board to take such measures or prescribe separate procedures or documentation for a class of importers or exporters, or for category of goods, or on the basis of the modes of transport of goods, in order to maintain transparency, expedite clearance or release of goods, reduce the transaction cost of clearance, maintain balance between customs control and facilitation. In this budget 2024, the words a class of importers or exporters, as can be seen on the left side of the screen, in this section has been replaced with the term a class of importers or exporters or any other person, and accordingly the government, apart from importer or exporter, may also notify any other person to follow such procedure or to maintain such documents as may be required to maintain transparency in import and export documentation. On similar lines, changes are also proposed in section 157(2)(m) of the Customs Act. The next legislative change in Customs Act is earlier the goods articles of foreign origin can be imported in India for repairs subjected to their re-exportation within 6 months, which can be extended to 1 year. Now, in order to facilitate and promote domestic aviation and boat and ship MRO, time period for export in case of aircraft and vessels imported for maintenance, repair and overhauling has been increased from 6 months to 1 year, and the same can be further extendable by 1 year. Further, earlier, the goods under warranty other than those covered in specified schemes under foreign trade policy can be re-imported for repairs within 3 years after their exportation, or within such extended period not exceeding 2 years. Now, the time limit of duty-free re-import of goods for repairs under warranty extended from 3 years to 5 years, and the same can be further extendable by 2 years. In order to promote Make in India initiatives, basic custom duty tariff rates are being increased on many commodities like PVC films, consumer goods, ammonium nitrate, PCBA of specified telecom equipments, laboratory chemicals, etc. Also, in order to promote domestic industry, BCD or tariff rates are being reduced on many commodities with effect from 24th July 2024, which are X-ray tubes for use in manufacturing of X-ray machines, flat panel detectors, cellular mobile phones, specified parts for use in manufacture of connectors, gold bar, silver bar, coins of precious metals, ferronickel, blister copper, etc. To conclude, I would like to state that the proposed amendments and insertions announced in the budget represents that the government is taking steps to reduce litigations under tax laws. Further, to apprise you all, these amendments will be effective from a date to be notified post enactment of the Finance Bill 2024. That's all from my side on key amendments under indirect taxes. Thank you all. Have a good day ahead. Over to you.
Thank you, Rashi, for sharing us valuable insights into new GST laws and changes in custom exemptions and new tariffs. Your expertise has provided us with a deeper understanding of crucial aspects of taxation. I hope our audience found the information shared today informative and beneficial for business operations. If you have any further questions or require any assistance with direct tax, regulatory issues, and GST compliances, our team is here to support you. You can reach us at communications@mbg.com. Thank you once again for joining us. We look forward to our continued collaboration at Trust MBG. Thank you so much.